In this video, guys, we're going to look at how oil moves with US dollar CAD. Stay tuned. Hey traders, warm welcome to you. Okay, so you may have heard of commodity currencies. These are currencies where the country is exporting a commodity, like Australia with gold, Canada with crude oil, and that means that that country's currency is affected by the price of the commodity. Let's take a closer look. So Canada exports 3 million barrels of oil and other petroleum products to the US per day. Right, pretty hefty amount. It makes up around 37% of US importation of oil, with Saudi, Venezuela and Mexico coming up a close second, third and fourth. Actually, they're pretty equal, Saudi and Venezuela. That may well have changed by the time you're watching this video. There's lots of stuff going on in Venezuela that might have changed things, but you get the idea. Canada is well out there. It's the biggest one ever. So that's going to affect the USD Canadian cross. It's going to affect the Canadian dollar. Why? 85% of Canada's exports go to the US. So if you think about this, if they are producing crude oil, in other words, they've got a fixed cost to produce a barrel of crude oil, and let's say that cost is $5. If crude oil is $50 a barrel, assume that all the costs are wrapped into there, they're making $45 a barrel. And the numbers aren't quite right, but I'm just using them for example purposes. Now let's say that a year later, crude oil doubles to $100 a barrel. The price of production stays the same at $5 a barrel. They're suddenly making $95 a barrel on that crude oil. What happens to that? That money comes in to the Canadian economy. And when money comes into an economy, when an economy starts to flourish, when the people are doing well, when they're spending money, of course the economy starts to boom, the currency becomes more valuable. Also because as inflation starts to kick in, as people starting to spend and are starting to, spend more and things start to become higher priced and it just gets a bit of a roll away, inflation starts to kick in, people, the central banks want to increase interest rates to stem that inflation, to encourage people to save and spend less. And then of course that has a double whammy effect on the currency because if the interest rate increases, that creates better demand for the currency from a carry trade perspective, from a fact that if you're holding money in that currency, you're gaining a decent interest rate on it, all these kind of things. And we've done a video on that a little bit more detail, go and check that out. So as US dollar demand rises, as US demand rises for crude oil, they want more oil. They're like, give me some more oil, I want more oil, more oil. So that could have a rise in crude oil prices. Canada's pumping away saying, here you go, take the oil, and the US wants more, so each person's outbidding each other for the oil. They want this, I'll pay 51, I'll pay 52, and that's why the oil price changes all the time. That will increase the value of CAD. So what is that going to do to US dollar CAD? Because CAD's on the other side of the pair is going to fall. The USD CAD is going to fall. And if you flip vice versa and say, listen, if demand starts falling, price of oil starts falling, then they're not going to get so much for their crude oil. The value of the barrel is going to be lower. The profit margin is going to be less. Money is going to come into the economy. All those things is vice versa. Don't need to go through all of it. USD CAD is going to rise because the Canadian dollar is going to fall. Okay, so we've got that. Now, let's take a look. 93% negative correlation with the US dollar CAD from the year 2000 to 2016. That's super interesting. All right, so oil has got a negative correlation, which generally means just literally the opposite happens. So when crude oil goes down, USD CAD goes up. When crude oil goes up, USD CAD goes down, just exactly like we kind of outlined in here. So what does that mean for you as a trader? It means that if you can look at crude, and by the way, bear in mind, guys, these things uncouple from time to time. There's supply demand things that separately come in, for the Canadian dollar or for crude oil that, doesn't necessarily mean that that's because that's going up 10%, that's going to go up 10% or down 10%. You've got to kind of take it with a pinch of salt, but that's reasonably good correlation. And so when you see a weak oil price and perhaps you see a good setup long USD CAD and oil continues to get weak, that might be an indication for you to say, hey, well, you know what, look at oil chart. Oil looks very weak. It's pulling back, keeps pushing to lows. USD CAD looks strong. We're pulling back to some support. I've got two things to leverage on here. I've got resistance on my oil on the upside to cap the oil price. I've also got support on my CAD, and I can play the one or the other and use that as a kind of proxy. So it gives me an extra edge. Same if, let's say for example, you were going long on US dollar CAD and crude oil was finding really heavy support, just couldn't break through the support. You might think, well, that might stem the strength or the power of this USD CAD move because there's really strong support on crude oil. Now, I'm just putting these examples off the top of my head. You can see how the negative correlation could impact the way you trade. It's worth remembering, do you want to import it as part of your trading plan? Perhaps not. But it's one of those things that's kind of worth remembering if you're trading US dollar CAD, knowing what is affecting the price of the Canadian dollar and thinking, okay, well, if crude oil is doing something unusual, perhaps I need to take that into account, or perhaps you don't. It's a commercial decision for you and your trading business. All right, guys, keep the risk manager, whatever you do. See you in the next one. Bye-bye.